In this video, I'm going to show you the process I go through to pick the stocks that I buy in my long-term hold portfolio. This video is prompted by an interesting research study done by a professor from Princeton. It was known as the monkey research studies you see here. As you see are clearly depicted, the analysis was, could a monkey throw darts at a Wall Street Journal page, could they do better at stock picking than experts? And the results were shocking. On average, the monkeys throwing darts at a Wall Street Journal page actually did better at picking stock winners as compared to the experts. And it wasn't even really close. So the question is, what happened? How these monkeys beat the experts? Well, part of it had to do with timing of the markets. You see, the study was done between 1964 and 2011. During that time, small cap stocks returned about 10.5% annually. Compare that to the 9.7% for all stocks, and then 8.6% for the biggest companies. By giving the monkey portfolio 30 stocks they could choose from, they were more weighted towards value-oriented stocks. And since value-oriented stocks did better than larger cap stocks, the monkeys beat the experts almost every time. But it does make you wonder, if a blind monkey like this could potentially beat an expert, is there any way to truly beat the market? And that's something I've thought about for over the past 20 years. And I've come up with a system to actually beat the market over the long term. And it's actually not that complicated. In this video, I'm going to show you my system and how I pick stocks to trade in or to buy for the long term. One important point to keep in mind when it comes to picking your own investments is that sometimes things just happen. You may have bought a solid, mature, consistently profitable companies, and then boom, like you see with Johnson & Johnson, a lawsuit pops up. And just understand, that's just a part of investing. Sometimes you'll have investments that go against you. So don't get too upset when that happens. Just reassess if that's a company you still want to own or not. And that's one thing that can make investing so challenging, is you have to deal with the ups and downs of situations like this with Johnson & Johnson, or even more recently, 3M. But if you pick companies like the way that I do over the long term, your winners will definitely outpace your losers. Set yourself up for success in a way that potentially you're able to beat the market. And you should do even better than the monkeys did. I'm going to share with you 2 ways you should consider investing for the long term. The first one is definitely not my favorite, and I don't do it, but it's so easy, I feel like I had to share it with you. That's simply to buy ETFs that have a lot of different companies in them. Here you see some nice examples of 4 different ETFs you might consider. We have SPY, which is the SP 500, or 500 of the largest companies in the US. We have the Qs. We have IWM, which is smaller cap stocks. And then we have SCHD, which is a common dividend ETF. One thing I like to consider about any investment is what its history has produced. Here you see the 1-year time frame of these 4 ETFs. Notice that the triple Qs have performed very well at 22%. The SPY, SPY, SP 500 at 20%. The small cap at 12%. And SCHD at 9%. So overall, when it comes to price return, we see the Qs have done really well. Now, will that continue? Most likely not, but that is what it's done over the past year. And here we see a longer term time frame for these same ETFs, and I've switched it over to total return, which includes dividends. Notice that during this time, the triple Qs or growth stocks, they've still outperformed everything else. But the SP 500, it's done pretty good, right at 100%. Small cap stocks have done okay at 52%, and the SCHD has actually done pretty good as well at 82%. Now looking at this here, you might say, I'd never invest in IWM, and I can see why. But in reality, you might also say, that might be an opportunity. Because over the past 5 years, small cap stocks or IWM, they've actually way underperformed everything else. And remember the monkey survey? Well, the reason why they won, because they were more weighted into smaller cap stocks. So just kind of keep that in mind. If anything, it might be worth having a piece of this in your portfolio. And just to do it, I have now switched over to the 10-year time frame for these same ETFs. Notice that again, during that time, triple Q or growth stocks have really done well, over 438%. And behind that, pretty far behind it actually, is the S&P 500, but still at a good return for the past 10 years at 240%. And SCHD has actually done pretty well because it pays that nice dividend, but it's actually just over 200%. And again, we have the small cap stocks. They are in last place at 127%. So this is an easy way you could just invest in the whole market. But again, you're not really getting any deals here. You're getting the average. And that's okay if you want easy. If you want easy, this is the way to go. You can just stop the video right here and move on. But if you want to do it in a way that you might actually beat the market, keep watching this video. Here's what I've developed over the past 20 years of investing in stocks and options. Instead of just blindly picking a basket of stocks, which is the right decision for some people, but not for me, I like to cherry pick my opportunities. Well, what does that mean? I like to buy stocks when I believe fundamentally their price to earnings ratio, their sales to price ratio, overall, they're at a spot where I think they're a deal. I'm not talking about a 5 or 10% deal. I'm talking about 15, 20, sometimes even a 50% discount what they normally trade at, and the results can be phenomenal. No, they don't all go your way, but as you see here, you can have some really big wins. This is a portfolio I started several years ago where I cherry pick opportunities that fit what I'm wanting to accumulate. For example, if I wanted to accumulate more dividend stocks, I'll cherry pick the best dividend stocks that I believe at that time are most undervalued. If I wanted to have some more growth, then I pick companies that don't really pay a dividend, but are potentially undervalued right now based on their history that will give me some growth if they return to their previous glory. But in all situations, I only pick companies that to me are fundamentally strong. They have a long-term track record of being profitable, of growing their earnings. They're not overloaded with a bunch of debt. Overall, they're very solid companies. Just at that moment, their stock price is beaten down. That's the companies I like to buy in my long-term hold account. I like designing this portfolio for myself. It's kind of like creating my own potentially undervalued ETF. I cherry pick every stock that goes in. When I believe it returns to fair value or becomes overvalued, I then can sell the stock out of that portfolio if I choose to. And if it's not a high growth stock, I do sell them. If they are high growth stocks, I tend to keep them even when they get to fairly valued or overvalued because I know that growth should be there. But one thing with this portfolio is that it's very diversified. I hold over 100 stocks in this portfolio. Now I am trying to decrease how many I have in this portfolio, and I'm doing that this year. But overall, it's very important to have a very diversified portfolio when you're cherry picking them yourselves. You don't want to have all your stocks or a lot of your stocks in just one or two sectors. You want them to be spread out into all different sectors. Now, a very big word of caution here. Don't blindly follow anyone's trades. You may say, Randy, I watch you on YouTube, I trust you. That's all great. Just use my trades as ideas. Please do your own research. I'm never suggesting any trade I do. Look at the trade. If it makes sense to you, do your own research. Make sure you understand all the risks of the company or the option you're buying or selling. Don't blindly follow anybody, including myself. Another important point to keep in mind here is that although I'm buying these stocks when I believe they are undervalued, obviously the market disagrees with me at that moment in time. So it could take months or even years before the market realizes that it's wrong. It's undervalued a company. And in some situations, I'll be wrong. Maybe the market knows something that I don't know and the stock price never really returns. It takes a lot longer to return to its previous glory. But overall, with the analysis I do, I believe the companies I pick are fundamentally strong. They're just undervalued at that moment in time for some reason. And one way to do that is to dig into the financials. Let me give you an example of that. Here's a healthcare company, ELV. Let's take a look at some of the financials to see what's going on with it. Does it look all right? When I'm looking at a new company, I like to look at these three things: the income statement, the balance sheet, and their cash flow. So let's start with the income statement here. What's going on with ELV's income statement? We scroll down here to revenues. Let's look at revenues. How do revenues look? On the far right, you see 2014. On the far left, 2023. Does that chart look good? It looks really good to me. Overall, the revenues are increasing over time. I really like that. I see no problems with that. Now let's look at operating income. Again, see a nice history of an increase in operating income. I really like that as well. And then we get to a very important number here, net income. What does this company's net income look like? Overall, we have 2014 here, and on this side, we have 2023, the most recent. Overall, we see a nice, steady increase in net income. That looks really good to me. Does it look good to you? Let's move on. Now let's look at his balance sheet. What do his assets and liabilities look like? Here we see the graph of its assets. Again, we see a nice increase, but assets by itself doesn't tell us the whole story. We also need to look at liabilities. So yes, assets do look good. Now let's look down here at its liabilities. And here we do see kind of the same thing with liabilities. They're not way outpacing assets, but they too are increasing. So keep that in mind that the assets are going up, but so are liabilities. So they somewhat offset each other. But overall, liabilities are not out of control compared to assets. That makes me feel good. And finally, we get to cash flow. And here we see cash from operations. Again, another pretty nice looking chart. A little more bumpy here, but cash flow overall looks good. It looks solid. It's not declining. You have 2014 here, and then as the years progress, we have 2023 here. So overall, nice increase in cash flow over the years. Now, what does their debt look like? Well, here we see long-term debt, and here we see total debt. Let's look at this. Overall, debt is not going out of control. This looks pretty good to me. I'm okay with the debt as well. So overall, ELV looks like a potentially interesting opportunity for a long-term hold, mainly because of its growth potential. It's not what I consider to be tremendously undervalued. It's more fairly valued, but overall it has a nice growth potential. And as you see, fundamentally right now, it looks pretty interesting. And by the way, you can find this information on free places like Yahoo Finance. A little bit harder to get a nice clear picture. So if you're willing to pay for something, Seeking Alpha, which is the website I've been showing you here, is a nice place to go. I'll put a link down in the description below. That'll give you a discount and also a free trial if you'd like to check out Seeking Alpha. Here you see a list I send out to my patrons every weekend of companies I believe are either fairly valued or potentially undervalued. ELV has made that list for several months now as a company I believe is kind of fairly valued. The bold ones are the ones I believe are potentially undervalued. But overall, a solid company that I'd be happy to own for the long term. So I looked at it fundamentally. Now, what's the next step? Well, something else you want to do is just kind of get to know the company in general. What does it do? What is it known for? Does it appear to be well run? Here's an example, just doing some general research on a company. Now, Kroger Grocery Store is one that probably most of you know and have heard of. And it's actually one I've traded in and out of over the past year or so. I bought it when it was really undervalued, and then had a nice sharp price increase and became fairly valued. In my mind, a little bit even overvalued, so I sold it. Now it's come back down a little bit. I'm looking for an opportunity to buy some more of it. If you don't know much about a company, one way to get to know them is to go on their website and see what they're known for. That's what we're seeing here with Kroger. So understand what a company does. What are their products or services? What are they known for? How does their website look? Get to know their staff, their employees. Just overall get a nice feel and understanding of what the company does. And one way to do that is to spend some time on its website. But in addition to just its own website, because that could be biased, you expect it to be biased, you want to get outside opinions as well and form your own opinion like we just did from fundamental analysis like we did with ELV. As you see here, that same company, Kroger, ticker symbol KR, it was one we did well with. We had a small position size in it. We bought it for the 43 to 46 area. We sold it for $54 just several months later. So overall, you see that even a grocery store company, when they're potentially undervalued, if you buy them right, you can make some really nice money on them. If you do some quick math, see that on average we made about $9 per share on this grocery store company, Kroger, ticker symbol KR. Those shares cost us around $45 per share. That means we made about a 20% return on a grocery store and right at 5 months. That's a pretty awesome return, especially for a grocery store. So by looking at the fundamental analysis of a company, you can determine if the company is potentially undervalued. And if it is, you don't know much about it, well, get to know the company, not only from a fundamental basis, but also from a product and services basis. Get to know what it does, and if it makes sense, go ahead and buy some. Just make sure you understand the risk you're taking before you do any investment, including a company that you believe is potentially undervalued. Speaking of that, sometimes investments don't work out. This is important to remember because you're making the best decisions you can. But sometimes you just don't have all the information or you just don't know what's going to happen in the future. Although I hate making a bad investment, I know doing that is just a part of what we do. Whether it's real estate or stocks or options or any business, there's just going to be times where you make a decision based on the information you have and it doesn't work out for you. And here you see one that didn't work out for me. So it's a lesson to you to just know that even though you do all this research, you do the best you can, not all investments will work out. Here's a company I still really like. It's Walgreens, ticker symbol WBA, but it just didn't work out for us. We bought it when I believe it was potentially undervalued, and I believe now it might still be potentially undervalued. But overall, fundamentally, it's just continuing to break down. It's not doing well. And as a result of that, I exited this position this past year for a loss. So when I entered it, it looked good, but as time passed, the fundamentals changed. I didn't like it anymore, so I got out. And it was a loser for me. So not all your picks will be winners, but if you do it right, most of them should be long-term. The fact that some sectors and some companies will be losers is another reason why you should be very diversified. Don't just diversify and say just dividend stocks, but diversify your overall portfolio. Unless you're really needing a lot of income right now, consider having some growth stocks in your portfolio. Consider having some income stocks in your portfolio. Consider having some stocks that are kind of a combination of the two. For example, here you see the income portion of my portfolio. I'm gonna tell you, this is the easiest money I make every month. Just in this little portfolio I started a few years ago, I'm receiving $3,900 a year in dividends. And on top of that, I'm receiving portfolio growth as these stock prices return to normal in some of these undervalued companies. Here you see some purchases and sales I made over the past month, and just a few of the companies I believe are potentially undervalued or on the one sale, overvalued. So have a nice diverse portfolio of stocks. If you can cherry pick them, you can do really well over time. So how do you find these stocks? Well, one way is to watch charts. Look at companies that are in trouble on the headlines, but maybe aren't in trouble fundamentally. If the stock prices are beaten down, then maybe dig into those companies a little more. In fact, that's what I do for my patrons every weekend. If you like a list of stocks that are potentially fairly or undervalued, every weekend I deliver to my patrons a list of companies I believe are fairly or undervalued. But have a way of accumulating some stocks that are potential opportunities for you to research further. That'll help you to build your own personal undervalued stock portfolio. So to recap, the 2 ways to consider building your portfolio is number 1, the easy way. That's to buy some ETFs, maybe diversify into several ETFs like SPY, QQQ, IWM, or SCHD, or other ETFs that you believe are good for your situation. That's the easy way. But if you want to try to possibly beat the market, find a way to have a portfolio of stocks that are potentially undervalued. And just make sure those companies fundamentally are very strong. Make sure you research them. But if you build a stock portfolio of potentially undervalued companies that are still performing very well fundamentally, over the long term, you should do really well. You just might even beat the monkeys. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. It's very important to focus on the right things when you're investing, whether you're investing in stocks or trading in options. At the video in the link above, I share the only 3 things I focus on when I'm trading in stocks and options. If you'd like to see what they are, go ahead and click that link. Until next time, happy investing, and we'll see you again soon.